In this video, we will see why a bond could be a lousy investment. Bond is a type of investment just like stocks. And bonds, there are a number of types of bonds. Some bonds are issued by municipality, provincial government, federal government, or most of the time by corporations, companies, they issue bonds. There are three, four numbers which are very important for a bond. One is its face value. Face value is actual worth given on the bond. It could be $100 bond, it could be $1,000 bond, and bond is known by its face value. Second is annual coupon rate. Coupon rate is basically a periodic payment made to the bondholder. Um, it's typically 5%, 6%, or like it could be any specific fixed rate. Years is the bond. All bonds are issued for a specific time period for its maturity time, and that is bond, also known as bond life. So it could be 10-year bond, 20-year bond, 15-year bond, anything like that. And the second thing which they specify in bond documents is payment frequency, whether it would be paid, yes, semi-annually, like 6 monthly after every 6 months, or annually, or whatever. If it's annually, then we say its frequency is one payment frequency. There will be only one payment in a year. If it's semi-annually or 6 monthly, then there are two, and so on. And the third factor, the last factor which impacts bond value is interest rate. What is the interest rate in market? That matters the most. So let's say this bond is 5%. With 5% coupon rate, adjusted coupon rate would be half of that, because actual coupon, that is annual coupon rate, and adjusted coupon rate is to be paid after every 6 months, so it would be half. Likewise, interest rate, if that is, let's say, 5%, adjusted would be half of that. Total payments, so because they are paying after every 6 months, so total payments would be for 10-year, total payments would be 20. So then when we calculate its present value, that is this formula in Excel in which we plug in, uh, it is value 1000. That means if we are buying $1,000 bond today at 5% coupon rate and market interest rate is 5%, we will not get even a single penny. It will barely maintain its value. Like whatever it would be eroded by inflation, it will be, that would be compensated through coupon. That's it. That's why it is giving us 1000. So let's say if market interest rate, market yield that goes to 6%, it would be cheap because market interest rate is higher than what we are getting. It will start losing its value. Likewise, if market interest rate is lower than our coupon, that would be the most wanted case, um, because we want to get some more money. But when companies issue bonds, include, most of the time they include specific clause, call by callback callback clause. Callback clause allows them to terminate bond contract anytime, whenever they want. So in most of the cases, when market interest rate is low, companies bond coupon rate is high, they invoke that clause and revoke, call back the issued bonds, and bondholder can't do anything. So overall, it has two benefits, two three two three pros, two three cons. Uh, One benefit for holding a bond is continuous cash payment. That's why most of the people who are close to retirement or who need continuous cash flow, they prefer a stable source of cash and buy bonds. And capital, the second benefit for it is its capital investment is secure. Like if companies go bankrupt or default, the bond value is secure. Whatever assets that company has, they would be liquidated and bondholder would be paid. On its disadvantages side, it's capital erosion due to inflation. So most of the time, in most of the cases, interest rates are higher than coupon rates. That's why bond basically loses its value. Because contrary to that, if bond rates are lower, if interest rates are lower than annual coupon, then companies would prefer to call back to save their money, and they do. So they basically want to leverage only for the sweet time period when interest rate is higher and coupon value is low. That is most of the companies when they issue. Whenever there is variation, they will prefer to call back and will leave bondholder just nothing to do. The second factor is bond coupon rate doesn't change over bond life. It will remain fixed, whatever is agreed upon at the time when bond was issued. Yes, that's pretty much it about the bonds. And if we want to play further with it, we can change our annual payments 3 or 4 or whatever. And here we can keep playing with it and can see how um, it goes. And so therefore, bonds could be defined on in three categories: par value, when coupon rate and interest rates are equal. That is like break even kind of scenario. Like 5%, 5%, it's maintaining its value. That's called its par value or break even. Second scenario is when annual coupon rate is higher and interest rate is lower. That means bond is profitable. And when bond is profitable, it will be sold on premium. That's why $1,000 bond could be sold at 1,300. Could be any value higher than 1,000. The third case could be when coupon rate is lower than interest rate. That means bond would be cheaper because bond will lose its value over time, and it would be cheaper. $1,000 bond could be available in 700, 800, 900, something like that, depending upon how much is the variation between coupon rate and interest rate. Yes, that's pretty much it. Thank you for watching this video, and if you like, please don't forget to like and subscribe this channel. Thank you.